What if a small group of people could influence mortgage rates, stock prices, business investments, and even how expensive your groceries become? They can. They're called central banks, and they sit at the heart of the modern financial system. Today, we'll explain what central banks are, why they exist, how they create money, and why investors, governments, and ordinary citizens watch them so closely. A central bank is the institution responsible for managing a country's money and financial system. Think of it as the bank for banks. Unlike commercial banks, which serve customers, central banks serve the broader economy. Some famous examples include Federal Reserve in the United States, European Central Bank in Europe, Bank of England in the United Kingdom, and Bank of Japan in Japan. Most central banks have three major responsibilities: maintain price stability, support financial stability, and manage monetary policy. But what does that actually mean? Before central banks became common, banking systems were often chaotic. Banks failed frequently. Financial panics could wipe out savings overnight. Economic crashes spread quickly. Governments realized they needed an institution that could act as a stabilizer during crises. This led to the development of modern central banks. Their mission became simple: keep the financial system functioning and prevent economic disasters whenever possible. One of the biggest challenges in any economy is inflation. Inflation occurs when prices rise and money loses purchasing power. Imagine a loaf of bread costs $2 today. If inflation is high, that same loaf might cost $3 or $4 in a few years. A little inflation is generally considered healthy. Too much inflation can damage an economy. Too little inflation or falling prices can also create problems. Most major central banks therefore aim for relatively low and stable inflation. The challenge is finding the balance. The primary tool central banks use is interest rates. When inflation becomes too high, central banks often raise interest rates. Higher rates make borrowing more expensive. As a result, consumers spend less, businesses invest less, demand cools down, and inflation may fall. When the economy slows too much, central banks may cut rates. Lower rates encourage borrowing, spending, investing, and economic growth. It's like adjusting the temperature in a building. Too hot? Cool it down. Too cold? Warm it up. But getting the temperature exactly right is extremely difficult. Here's where things get interesting. Central banks can create new money, not by printing mountains of cash, as movies often suggest. Most modern money creation happens electronically. During major crises, central banks may purchase government bonds or other financial assets. This injects liquidity into the financial system. One famous example was quantitative easing, used after the global financial crisis and during the COVID-era economic disruptions. Supporters argue it helps prevent economic collapse. Critics worry it can contribute to inflation and asset bubbles. The debate continues today. Central banks are among the most influential institutions in the world. Their decisions can affect employment, housing markets, government borrowing costs, stock markets, and currency values. Supporters argue that central banks need independence from politicians. The idea is that economic decisions should be based on long-term stability rather than short-term political goals. Critics argue that unelected officials wield enormous power over society. This tension between independence and accountability remains one of the most important debates in economics. Whether you realize it or not, central banks influence your financial life every day. They shape interest rates, inflation, economic growth, and the stability of the banking system. Their goal is simple: keep the economy stable. But achieving that goal is one of the most difficult tasks in the modern world, and every decision they make can ripple through the entire global economy. The next time you hear that a central bank raised or lowered interest rates, you'll know why the news pays so much attention. If you enjoyed this video, subscribe for more explanations of economics, finance, and how the global financial system really works. And in the comments, tell us, should central banks have more power, less power, or exactly the amount they have today?